Hi and welcome to the Starting a Business Risk Management video lesson. This video is part of a project titled Marketing Opportunities for Missouri's Niche Meat and Poultry Processors. I'm Alice Roach and I'm a Senior Research Associate at the Division of Applied Social Sciences at the University of Missouri. And I'm joined here by Caleb Colbert, who's an attorney with the Haden and Colbert law firm. So for this video lesson, Caleb will share about some risk management factors to consider when you're determining how to legally structure a business depending on your business model. So take it away, Caleb.
Thanks, Alice. As Alice said, good morning. My name is Caleb Colbert. I'm an attorney with Haden and Colbert here in town. And one thing we wanted to talk with you about this morning is something that a lot of my clients encounter, a lot of folks encounter when they go to expand a business or they go to start a business. What things can they do to sort of manage risk? Because inevitably, when you're dealing with the general public, when you're dealing with customers, when you're dealing with employees, you're exposed to some level of risk. So we wanted to put together at a high level some kind of bullet points and some action items that you can do to protect yourself, to protect unrelated business assets, that sort of thing, to at least get you thinking about steps that you can take to sort of minimize exposure to potential claims or potential creditors. However, the risk management or the risk mitigation is really only one aspect or one consideration that you have to keep in mind when you're opening a new business or expanding a business. The risk management kind of deals with those first two bullet points on your screen: contractual creditor protection and tort liability protection. When we talk about contractual creditors, we are talking about folks like the bank, for example, or a landlord, folks that you have a contractual relationship with in your business, that you're making regular payments to, that they're essentially known creditors, people you deal with, on a regular basis. Tort liability goes to folks that may come into your business, may have an accident or be injured, sort of that personal injury aspect of it. That's sort of the tort liability that we're going to talk about in a little bit. However, again, there are other considerations to take into account when you're starting a business or expanding a business. One is your personal investment horizon or your timeline. When you open this business, is this something that you're intending to operate for the rest of your life? Are you intending to operate for a short period of time? Is it sort of a gap filler between the next chapter in your life? Is it something that you want to pass on to your children? All those things impact how you set up your business and what sort of structure you choose. Obviously, the tax implications are also important to consider. You want to have a good accountant on board that you can get with and run through some of the tax scenarios and decide what is the most advantageous from a tax perspective, because inevitably there are going to be tax consequences from the type of structure you select and the number of entities you select. All those sort of things impact the tax outcome. Finally, there are a variety of different structures available under Missouri law that you can go with. Some are very flexible, some are very formal, and ultimately that is a personal preference for you to decide what level of flexibility you want in your business versus what level of formality you want in your business. But really what we're going to focus on today is the risk management side, those first two bullet points. So the first thing that we can do to really minimize risk and protect assets is, again, we're looking at risk management, not risk elimination. Again, when you deal with the general public, when you have employees, when you invite people into your property, no matter how much money you spend on insurance, no matter how much money you spend on lawyers, it's impossible to eliminate risk and be 100% protected. So what we're talking about today is how we increase the odds and increase the likelihood of protecting those assets. But again, you're dealing with people. And if a claim is made against your company, if a claim is made against you personally, ultimately that claim is going to be resolved either by a jury of your peers in a trial or the judge. And again, you're dealing with people and they may make good decisions, they may make bad decisions, but we're talking about how you put yourself in a good position to protect assets at the end of the day. So goal number one is to keep your personal assets beyond the reach of your business-related creditors. Again, we talked earlier about the bank or the landlord. So we want to make sure that your own personal banking account your wife's personal banking account, your children's personal banking accounts, all of those are beyond the reach of those business related creditors. And then goal number 2 is if you have multiple businesses, how do we keep the assets of those individual businesses separated and segregated and protected from creditors? Step number 1, the number 1 thing you can do to mitigate risk and to manage risk is to have good insurance. This seems like common sense, but a lot of folks, when they open a business, they just make a quick phone call to their insurance agent, get a policy, and they don't put a lot of thought into it. But you can really protect yourself if you put a little extra effort into getting insurance on the front end, because there is an insurance policy that provides for coverage for nearly every risk you will encounter in your business. For example, a personal injury claim. Again, if someone comes into your property and they slip and fall, or they're injured, or you have an employee that's involved in an automobile accident, there's a liability coverage for that claim, which will be the first line of defense against any kind of claim against your business. Defamation is another good example. If a competitor says you're making false attacks against them and you've slandered their reputation, there's insurance coverage for defamation claims. Product liability. Product liability is something where if you're producing a product and someone consumes that product and they get sick, there is coverage for those claims as well. Property damage is another type of insurance coverage that's available. So if, for example, your building catches on fire, there's a flood, there is property and casualty insurance that will indemnify you against those particular losses. So the number 1 thing you can do right out of the gate when you decide you're going to expand or start your business is contact an insurance agent and make sure you have adequate protection. Now, insurance is not a perfect solution because insurance provides a defense and indemnity against covered claims. So your insurance policy is going to have insuring language in it, which says exactly the type of risk or the type of accident that is covered by that policy. And the insuring language is pretty short and sweet. And then at the end of your policy, there's a long list of exclusions, which basically walks back the extent of the coverage to some extent. So your insurance policy it's not magic. It's not going to provide 100% protection, but it will provide protection against a lot of the risk you're going to encounter. It's also not a perfect solution to some extent because the insurance coverage only applies up to a certain policy limit. So for example, if you have an insurance policy of $100,000 or $200,000, but someone is injured at your place of business and they have $1 million in medical bills, your insurance policy is not sufficient to cover all of their potential damages. And in that case, the individual that's been injured has a right to look to the business to cover the rest of their damages. So there is some exposure to you, even though you have an insurance policy. So the insurance policy limit is the maximum amount that the insurance company will pay out if there is a covered claim. The other issue you sometimes run into with insurance is that it only provides coverage for claims made during a certain time period. Generally, it's either a claim has to be made during the policy period or the accident itself has to occur during the policy period. So if either of those things aren't true, if it occurs outside of the policy period or the claim is made outside of the policy period, there's a chance that you would not have insurance coverage. And so that leads us into what can we do next? If insurance isn't perfect, what is the next best thing we can do? And that is to form some sort of legal entity. And why do you want to form some sort of legal entity? It's to take advantage of what we call the corporate veil. So the corporate veil is something that is recognized in all 50 states. It's recognized here in Missouri. And it says that a legal entity is a separate and distinct owner or a separate and distinct entity from its owners. In other words, there is a veil between the owners of the company and the company itself. It is one of those things where in the eyes of the law, a corporation is a person and a person is a person, but they are separate legal entities. And the same is true if you have multiple businesses. If you incorporate each entity, or you organize them both as limited liability companies or partnerships, those are all separate legal entities. So not only is would I as an individual be different than the company I own, but if I own multiple companies, they are separate and distinct. And there is a veil between myself and each company and each of those companies that I own. So what does this mean as a practical matter? So as a practical matter, if you are able to take advantage of this corporate veil, the company's liabilities are not your personal liabilities. In other words, if you own a company that, again, owns real estate and makes a monthly mortgage payment, that is not your personal obligation as long as you have everything documented properly and you have everything set up properly. Similarly, if you have one entity that owns real estate and makes a monthly mortgage payment, and you have another entity that rents real estate or rents an office space, those liabilities don't go back and forth between the companies. And the same thing is true for assets. So big picture, if you're able to take advantage of the corporate veil by forming some sort of entity, you're able to protect the personal assets and you're able to avoid liabilities passing from the company to you personally or between companies that you own. Now there is, as with everything in the law, there's always an exception. And the exception that we have here in Missouri and in other states is the alter ego theory to pierce the corporate veil. And what this theory holds is that if you don't observe corporate formalities, if you don't actually treat your corporate entity as a separate and distinct entity from yourself personally, and you treat it as your alter ego, a court will sometimes do what we call pierce the corporate veil. And in that situation, a creditor of your company may be able to get to your personal assets. So we want to avoid that outcome. And what courts look at is, do the owners of the company observe the corporate formalities? For example, do we keep separate records? Do the owners' records, are they separate and distinct from the company's records? Are the assets of the company separate and distinct from the individual owner's assets? For example, is the business owner using company assets to go out and buy groceries for the family? That sort of thing. They also look at owner compensation. Is the owner drawing a reasonable compensation from the company, or is he treating it essentially as a slush fund as he draws money out of the company? One other factor they consider is if it's a single owner entity. And the reason the courts look at that single owner entity, because if you have multiple owners, you have more people involved in the process, you're more likely to have observed what we call the corporate formalities. You're more likely to be treating the company as an independent structure, as an independent entity, where you have multiple people paying attention to the money going in and the money going out. It's unlikely that in a multiple owner structure, you have anyone that's treating the company as their own alter ego. So some things we can do to sort of increase the likelihood that the corporate veil will be recognized and the veil will not be pierced. Obviously, number one is never use business assets to pay for personal liabilities, personal debts, or for personal use. The way the process works, if you have your own business entity, is that business receives income. That business then pays its expenses. You're then entitled to receive a distribution, a dividend, draw, or salary of some sort from the company, but you're not able to pay your own personal expenses directly out of the company. On paper, the flow of the business income needs to follow that process. Obviously, once you've received a salary or distribution, a dividend, whatever you receive from the company, at that point, that's your money. You're free to use it however you like and pay personal debts, buy groceries, whatever. But the business can't short circuit that process. As I mentioned earlier, again, one thing that the courts look to is the number of owners in the business. So a single member owner entity is the entity that is the most likely to have the veil pierced. So what is something that is simple and easy to avoid that? You can consider adding a spouse as an owner of the company. You can consider adding a child as a spouse of the company, because at that point you've added multiple owners. And again, the court looks at it as well. It's not likely that this is going to be the alter ego of any one member if there are multiple members in the business. So far we've talked about these first two layers. If we are trying to protect personal assets and mitigate risk, step number one is to look into getting good insurance that has sufficient policy limits and it provides coverage for the type of risk that we expect to encounter in our business. Step two would be to form an entity or a legal structure of some kind for that business. And step three is if we have a complicated business structure, or if we think we have a high likelihood of risk in multiple businesses, we're going to separate out our business units into separate entities. And what I typically recommend to clients is that you look at your business. You identify where you have a distinct type of risk, and you put that distinct type of risk in its own bucket or in its own structure. The example I have here on the slide is a medical practice that owns its own building. Obviously, being a doctor and providing healthcare is a very high risk activity. But if that medical practice also owns real estate, there's nothing inherently risky about owning real estate. So typically what we do in that scenario is there'll be overlap with the ownership, but we have an operating entity which conducts the medical practice, and the doctors are all employees of that operating entity. And then there's a separate holding company that essentially holds title to the real estate. And the reason for that is it separates the high risk activity from a low risk activity that has a very valuable asset, and that being the real estate. And again, I went into a little more detail here on, the relationship between those two companies. Obviously, the operating entity can lease the real estate from the holding company, and then there's a contractual relationship. They're entitled to pay rent, that sort of thing. But the practical outcome of this is that real estate is put beyond the reach of any creditor of the medical practice. There are also some additional advantages to going that route. One, there is some accounting and tax flexibility when you have that kind of relationship between two companies, and you have one that owns real estate and one that owns medical practice. It gives you also some flexibility in ownership if you want to have different investors on the real estate side versus the investors on the operating entity or the practice side. It also gives you some flexibility in compensation. There is some downside to setting up multiple entities and having a complex business structure. All of that complexity comes at a cost. And that cost is you're going to have multiple bank accounts. You're going to have several accounts with the accountant. You'll have multiple tax returns. You're going to have separate insurance policies. You will end up having separate corporate records, things of that nature. But what you have to weigh as a business owner is all of the burden of that, all of those kind of duplicate systems. Is the burden of that cost, is that outweighed by the benefit of having a complex business structure, which provides you the additional protection of your assets? And most of the time, depending on the nature of the risk of the business and depending on the assets that the business owns, generally speaking, people are willing to explore that complex business structure because it protects assets. Again, as I mentioned before, there are a lot of other considerations to take into account when you're starting or expanding a business. Again, flexibility, your timeline, the tax implications, and estate planning. But from a pure risk mitigation, risk management perspective, the things you have to consider right out of the gate: one, what kind of insurance do I have? Two, should I go ahead and form some sort of legal structure? And three, if I have distinct businesses that I'm operating, should I put those in separate entities? And from there, that should handle most of the risk that you're going to encounter as a business owner, as a sole proprietor, or as someone that wants to expand the business.
Thanks for providing that overview. You described how the multiple entity structure would be a good strategy to consider for managing risk. And we have a lot of existing meat processing businesses here in the state that may add different enterprises over time. So what are some signs that an existing business should look for to determine whether it's ready to spin off one of those enterprises into a legal structure of its own?
So I would look at, does the enterprise, does it need its own employees? Does it need its own accounting system? Is it really kind of starting to get its own 2 feet, so to speak? Is it operating in a way that is really separate and distinct from what I call the parent company? And if you're noticing that you have employees that are dedicated almost exclusively to new enterprise, or you have resources that are dedicated exclusively to that new enterprise, it might be time to spin that off and put it in its own structure or its own entity of some kind.
Okay. But you also mentioned that there are some disadvantages in a way, because there are some administrative costs that are tied to operating those multiple entities. Is there a typical cost to consider or to assume if you're wanting to spin off an enterprise into its own entity? What are the costs related to doing that?
So, I mean, it's going to be different in every situation, but ultimately you're going to have the additional cost of, another tax return, additional insurance policies and additional insurance premiums. So that will impact the actual dollar amount to some extent, how much coverage you have, what your premiums end up being, that kind of thing. You also have the additional cost of, if you're going to split out employees, then you have a completely different payroll system. That is something that you're going to deal with on a day-to-day basis. You'll have an additional cost of having multiple bank accounts, separate bank accounts, all that kind of stuff.
And do you recommend that businesses evaluate their existing enterprises on a semi-regular basis so they can assess whether it may be time to spin off a business into its own legal structure?
Sure, absolutely. I mean, it's sort of like any other facet of life. If you've gone through a life change, for example, if you've had children, you've gotten married, people would recommend that you look at your estate plan. And the same is true for a business. If you've brought in new owners, or you think that you're getting ready to expand, if there's it may seem minor change to you, but if there's a change on the horizon, you really ought to evaluate whether or not your existing structure is appropriate for protecting against, potential claims. But certainly you don't have to wait for some sort of change like that to evaluate your situation. You can evaluate it obviously at any time.
Great. And one last question for you. You mentioned the different types of legal structures, or different practices of using different legal structures to provide that protection that's afforded by the corporate veil. So what are some of those legal structures? For example, you can incorporate, you can become an LLC that provide that type of protection.
I mean, your general structures, the most formal is going to be your corporation, a for-profit incorporated entity. Your probably least formal and most flexible is the limited liability company. And candidly, that is what most folks have looked at as kind of the best structure to go to. And and the reasons for that is it's the most flexible, and you don't have to follow all of the corporate or the rules that apply just to a corporation. For example, having annual meetings, keeping stock certificates, and keeping track of who's a shareholder in the company. Those don't necessarily apply to a limited liability company. It's a lot more, it's the least cost, most flexible business structure out there. There are other alternatives too. I mean, there's general partnerships and limited liability partnerships. But generally speaking, for most folks, the limited liability company has kind of the complete package of what you're looking for to get some asset protection, but still allow you to, have that corporate veil with some flexibility.
Awesome. Well, thank you, Caleb, for sharing these insights, and thanks to our audience
Sure.
for joining us.
Yep, happy to help. Happy to help.